waiting for rates to drop is costing you millions of dollars. Lost opportunity cost, Joel. That's why. Lost opportunity cost. The cost of doing nothing costs you tons of money. All right. What is up? And welcome back to another super exciting, awesome, best ever episode.
Welcome back to an episode.
Woo-hoo! Okay, that's going to be interesting to edit. But we are back.
Angel can handle that.
Better than ever.
She's really good.
Ready to talk all things commercial real estate. Brian is all the news all the time. He said it himself, self-proclaimed.
But first, let's talk about this mid-season slump the Thunder are in. I hate to call it a slump because we still have...
It's a slump.
Oh, you're going for full slump. Yeah, well,
slump.
It sucks because we went from like 24-1 to... I mean, we've lost like 11 games.
12
games.
12.
12.
We're getting our asses kicked, folks.
We'll be back. Everybody gets healthy.
Up and down the court.
I think we're waiting for everybody.
Well, last night against the Spurs, this will date when we taped this, but I think we had 3 people on the bench. We had 8 available guys.
Yeah, that's tough.
So, still best offensive team in the league. I'm done taking a shit on them. I'm gonna go the opposite way.
Give us the stats.
Best offensive team in the league. 123 points per game average. We're showing up.
That's pretty good.
Rebounds, middle of the pack. That's probably got something to do with it. Field goal, 49%, top 3. Nothing super amazing there. Best defensive team in the league.
And we have the best offense and best defense in the league.
Only allowing, on average, 108 points per game.
Yeah. And I think we have one of the most lost games to injury of any team in the NBA. So,
yep.
We'll be back.
Shea still averaging 32 points per game. So pretty good.
So who are we saying is who are they saying is
how about
leading MVP right now?
It's close. Shea's up there for sure. He's probably in the top 2 or 3. Luka is up there. He's having a good year. LA's tough.
I mean, after what he went through, he had to. You either knuckle down and prove the world wrong and make sure everybody knows that it's the biggest mistake ever that you were traded from the Mavs.
I mean,
and he's shitting on him right now, bro. He's absolutely shitting on him.
He is a whiny little bitch, but he's a good basketball player.
It's better than watching Jokic's, fat tail run up and down the court. He just looks exhausted after the first play.
He's a little off this year, actually. From his stats last year were so stupid.
I mean, he's still averaging a triple-double, I think.
I mean, he's still amazing.
He's still amazing. But
okay, well, let's move right into our first game of the week. And we're going back to I Call BS. I Call BS.
I may try to.
I usually beat Braden at this one.
I
did.
After what happened.
Oh, you did beat him by 1. Yeah. These aren't the hardest questions this week, but they are something to think about.
Okay.
The stock market has spent more time below its long-term average than at all-time highs.
That's got to be true.
Below. Yeah, I think that's true.
False.
Did we say
false? See, you were saying what I said and it bit you in the ass.
Yeah.
So you both missed it.
Yeah.
Think about it. The stock market has been setting all-time highs since the stock market became a thing.
Yeah.
Okay. Well, there's a longer period of time in the past decade.
Okay. Inflation has done more damage to savers than market crashes do to investors.
That's true.
That's got to be true.
That is true. The slow erosion beats sudden drops. Yeah. Okay. Most professional fund managers underperform their benchmark even before fees.
True.
False.
It's after fees.
They underperform after fees. Before fees, many cluster right around the index.
Okay.
I knew that.
Over the
question.
Over the long run, dividends have contributed more to total stock returns than price appreciation.
I'm going to say true.
False.
It is false. So are you up 1, Braden?
I'm up 1.
Yeah, he's up 1.
Okay. All right. Let's see. We'll keep going here. Office vacancy rates are high today, but are not as high as they were during the global financial crisis.
False.
I'd say false.
You are right. They are higher today than they were.
Yeah, Braden's he knows that I know.
All right. Confidence and competence are correlated across various investment sectors for the individual.
There's no way that can be correlated. I would say false.
I'm going to go with false, too.
You guys do whatever. So it is false. The reason, think about it, guys. You're like, we're experts. We're not, maybe not experts, but we're really good at multi-tenant retail. I've got some multifamily, but my confidence and my competence do not correlate to how I would be at crypto as a prime example.
I was just thinking I would be so much richer if they were correlated.
Yeah. So think about the Dunning-Kruger effect, right? We get a little information, like I get a little information about crypto and I think I know what I'm doing and I don't.
That's actually exactly what I was thinking of, is the Dunning-Kruger effect. That's what took me so long to answer. Actually.
Okay. The world is poorer today than it was 50 years ago when adjusted for inflation.
False.
I think that might be true.
It is false. Global real income per person has risen dramatically. So Braden's up 2.
I may throw the next couple just to not beat him too.
All right. After adjusting for inflation, China's average citizen has seen slower income growth since 2000 than the average American.
True.
I'm going to say true.
It is false.
What'd you say?
I said true.
Yeah.
You are more likely to be killed by a falling object than by a shark.
It's probably true.
Really? Falling object? Just to make up, I'll say false.
It is true.
Three,
and that's
folks.
a good one to think about, guys, because we are really not great at assessing risk on a global scale. It's all perceived risk for us.
Yeah, shark.
And some things are scarier to us, but if we really look at the stats, it's not. And I think the same can be applied to certain financial situations.
Yeah.
Okay, here's one. Humans can detect lies better than a coin flip.
What is that even supposed to mean? What does that mean? What does that mean?
Do you understand
I
the
think-
words that are coming out of my mouth?
I think, we're more likely to do that. So
How
I'm gonna go-
does a coin flip detect a lie?
Well, just call it chance.
Yeah. I'm going to say true.
I'll read it that way, chance.
I'm going to say true.
Better than chance?
Yeah.
Humans
Yeah,
can
because
detect a lie
we're more
better than
perceptive
chance.
than 50-50.
I'd say false.
It's BS. Yep, Braden's right. Even experts perform barely above a coin flip when trying to detect human
Well,
lies.
that's not true for me.
All right. Lastly, history's deadliest events were caused more by disease than war.
True.
True.
Yes.
He totally copied that.
No, it's true.
We all heard it.
All right. Braden wins again.
No, he didn't win this
Utter
one last
domination.
week. He didn't win this one last week.
Yeah, but he won both. He won this game this week.
Two in a row, I think.
Okay, well, it's
Anyway,
I'm
just
not
food
on
for
that.
thought. Always challenge your preconceived ideas, your biases, your assumptions. I call BS. What do we got for a topic today?
So this was super interesting because we've been in a high interest rate environment for quite some time. And it's really why waiting for rates to drop is costing you millions of dollars. Why waiting for rates to
I'm
drop
ready to hear. I can't wait to hear why it's costing me millions of dollars.
is costing you millions of dollars. It's a lost opportunity cost, Joel. That's why. Lost opportunity cost. Cost of doing nothing costs you tons of money.
I think I agree with that.
Yeah, so I think it's something we hear all the time of like, how are you guys buying right now? Oh, I'm waiting for rates to drop. I can't get in, yada, yada, yada. And I feel like it's the biggest hunk of junk ever, right? Because when rates were cheap not too long ago, 5-6 years ago, you couldn't buy anything. Everything looked great. It would model up great, but then there would be 13 other bidders and it'd drive the price up above ask.
Mm-hmm. So you ended up with not so good of a deal.
Yeah, it compresses spreads. So you've got to get in even why debt is expensive. It may seem daunting, but you've got to look for value add components, right? In this rent growth, high inflationary environment we're in, you don't have to accept that day one return as forever, right? You can look for lower lease term. You can look for vacancy. You can look for ways to add immediate value where you can capitalize on that. And you can still get deals done in a high rate environment, which is what we all want to do. The big core misconception here is that lower rates equals better deals. And I think it's really just a prejudice to paying interest. It's a cost that they're paying out of pocket. So they're saying, oh, it's more expensive. I got it a few years ago at 4%. But the reality of it is you're still borrowing it for less money than the deal is making, right? Theoretically, you're still having a positive leverage deal. If you're not, you're just don't do that. Don't do negative leverage. If it's one thing you learned from this podcast, it's focus on positive leverage, folks. So we've got positive leverage, which means there's excess cash flow after we pay the debt. So why wouldn't you want to get that? Even if it's 10%, even if it's 20%, if you're doing a deal with positive leverage, you should do the deal. If you believe there's rent growth to be had and you're going in with positive leverage, you should do that deal.
You think about, well, what if rates go up? That could hurt. Well, you do have some protection because whenever you don't have to get a floating rate debt, you get it fixed for 5 years, 7 years, even 10 years or longer. And so all you got to do there is if it cash flows today with the debt you're able to get on it, your rents aren't going to go down, unless there's just some catastrophic global event with the economy. So the rents are going to stay the same or move up, and your debt's going to stay the same. And so within that 5 or 10 year window, if rates ever come down, you refinance and lock it in even longer. So yes, they could go up, and I guess you could say, well, what if in 5 years rates are higher? That is a worst case scenario, but you've increased the rents for 5 years. So your hope is that you at least are able to pay that new higher rate when that 5 years comes. And eventually, if rates went up, they might come back down, and all you're waiting for is one opportunity to refinance lower and increase your cash flow.
Yep. So the biggest misconception is rates don't create value. Pricing adjusts to absorb them. The benefit of lower rates is captured by the seller, not the buyer. Because when rates get lowered, prices go up immediately. The market resets immediately, because they know your cost of capital is lower. They're underwriting your returns for you. That's what made it appetizing for you to buy in the first place. So that's what they're underwriting to. They're underwriting to the same return. If debt's cheaper, they're capturing that in value. So it's almost like Black Friday shopping. And if you like Black Friday shopping, then you can maybe just tune out now because you're not going to like the analogy. But if you're you just shouldn't need to wait in line completely around the store because it's $20 off. Like it's 10%, right? Just go in, pay a little bit more money, get it when you want it, when the best time is for you. Like that's what the deal is here.
Well, right. The only difference is Black Friday, you're buying something that's going to go down in value all the way to zero. And you may want that discount. But in real estate, given enough time horizon, it'll always be worth more in the future. And if you don't know why that is, listen to a few of the other podcasts. We go over it. But the rents are going to go up, the value's going to go up. And so we're saying go ahead and get your money invested and get it earning a return.
Yeah, and when you go into the deal now, when rates and you figured out how to get positive leverage, even if you're paying 7-10%, whatever it is, it's a positive leverage deal. You've got a high interest rate. When rates lower, you can do two things: you can sell or refinance the deal to capitalize on that lower rate. But you are capitalizing on it. So by following that thought process, rates are probably going to come down eventually. They go up, they go down. So wherever you are in that cycle, it's good. Right? Because if rates go down, you capture that value and you sell, and then you use that money when rates are cheap, again, to go bid and be competitive with everyone else. Like you're still going to be able to get deals done. In that case scenario, you don't have to be so aggressive on rent growth because your debt is cheaper. It's a different deal structure. So that's misconception number one. Number two, deals price to today's debt. So the big thing in buying in high interest rate markets is sellers are conceding on a lot of points. Right? Like we discussed, you not only don't have to wait in line, but sellers are conceding on pricing. If they have to sell,
they know they have to.
They have to meet the market where it's at, which means they have to appreciate what my debt cost is. Like I said, they're factoring it in. They're underwriting our returns for us.
Yeah, they know.
They know. So if they are a true seller, they're going to meet market where it's at. They're going to concede on price. Number two, seller financing. This is completely on the table now, right? Like if they're willing to sell, maybe you could pay them a better price, but you get some flexibility in seller financing because they need a little bit of cash now, but they'll wait a few years and they're going to give you a high rate, 6, 7, 10%, whatever it is on that seller financing capital. They're going to be open to that. A lot of deals are getting done that way. We don't do a lot of seller financing deals, but I hear of a lot of people that do them. Rate buydowns, we don't really do a lot of. Preferred equity, longer due diligence. Preferred equity, again, we don't do a lot of, but longer due diligence, this is huge. In a highly competitive, cheap interest rate environment, you'll get maybe 30 days of due diligence. Maybe. We've gone and been pressured to do non-refundable earnest money. We've gone and done week, 2 week, 3 week due diligence periods when the market is hot, debt is cheap, and you find a good priced asset. You have to get competitive. Other people do that by not only increasing the price, but shortening their due diligence timelines, which puts pressure on everything and everyone. Like just getting an appraisal done in time, getting a loan commitment done in time. You're opening yourself up to undue risk. These concessions disappear when rates fall. 100%. 100%. When there's a competition and buyer pool out there, the ones who have their shit together and can offer cash or amazing terms get the deals done. When REITs are buying, they go in and scoop stuff up in all cash. You can't compete with them whatsoever. There's There's no competition against those guys. Yeah, we already touched on loans.
I just want to go back to something that you said. You buy right now with positive leverage. Rates go down, you win, right? How awesome can you? How awesome to own an asset where they start lowering rates or rates are coming down, and the value is just automatically going up. But let's think about the alternative. Rates go up. Well, number one, I have a fixed interest rate. Okay, so I have a protection for a certain window of time. But two is what's happening when rates are high. Inflation's high, and that's why they're raising rates in order to bring inflation back down. And in high inflationary markets, when we're getting the most rent growth.
Yep.
Okay, and so you have two hedges against rates going up. You have rent growth, and you have a fixed rate that's giving you a time horizon. Okay, so you have some protection on the downside, but then you have all of the upside to capture if you buy deals when rates are higher. If rates ever go back down and you own that asset, you can refinance them lower and take advantage of that, or you can sell and maximize purchase price. So,
yeah, that was one of my next points. Is high rates create a higher discipline on the deal. You have to focus in and really believe the rent growth story because you know the risks you're taking. You're paying more for debt. You know, it's easy to make mistakes and get a sloppy underwriting when debt is super cheap and you feel like you have a ton of spread. You can just assume everyone's going to stay and you don't really need to increase rents a ton. That's super cheap. You know, the hidden cost of waiting. Here's where the millions becomes real. Break it down. Lost cash flow for a year or years, potentially. How long, when did rates just go through the roof? Was that 23?
22, 23.
22, 23. Yeah. So we're in the beginning of 26. So we're in 2 to 3 years of if you paused because you couldn't figure out how to pay and service your debts at a higher interest rate, then you've lost out of hundreds of thousands, if not millions of rent growth.
I will make a comment here. We did, when rates were going up, actively going up, right? We did pause. Yeah. Because even though sellers, when rates go down, they instantly adjust their price because they want to take advantage.
Yeah. Yeah.
But they don't want to instantly give you a benefit when rates are going up. Yeah, they want to hang on. They're stubborn,
Slower.
Right? They don't want to accept it. And so the prices do lag those interest rates. So there is a period where we did pause. But once rates had stabilized, that's when we started to see pricing go down, cap rates come up. And that's when we started to get really aggressive because we knew it was a better odds that rates were going to go down from that point than keep going up after that pause. I mean, that's pretty much sums that up. I think we've tried to execute that. That's why we purchased so many deals the last year or two, and why we're going to purchase so many deals this year. And I think it's going to really pay off for us and the investors.
Yeah, it's coming to fruition because the rates are going down, right?
Rates are trending down.
Yeah, we'll see. We're kind of in a weird spot right now where inflation is kind of staying low, and the market the market is kind of staying hot, and so I don't know what's going to break first here, what we're going to see in the next few months, but they've kind of paused the rate reductions for now, and then we'll kind of have to see in the next 6 months where it goes.
I mean, hopefully it's the market. I hope they do nothing. That's my hope. Let it do what it's going to do. We don't need to force rates down and like artificially prop it up. The jobs report wasn't amazing. Inflation's kind of in line with what it was doing a year ago. We talked about that last episode. So I think at this point, it's been on such a long run up. Everything has. We need somebody to just let the market do what the market is going to do, I think. There's a lot of uncertainty right now. I think specifically in AI and just the future of what jobs over the next 5 to 10 years are going to look like. And I think that's causing a lot of panic into how safe can we get. That's why you're seeing gold and silver go through the roof.
Well, if you are a finance expert or if you just have an opinion, we'd love to hear your thoughts on where rates are going. Yeah, we can. Are they going to stay set? Are they going to increase? Are they going to go down? And what your thoughts are on buying through a high rate environment. We'll hit you up next time on how to invest in commercial real estate. See ya.
Yep. Thanks, guys.